In the States, right, the dividends that you will get is around 2%. Or around, it's around that range. If you get something more than that, that's a bonus already. Here, before I invested in US stocks, I was just investing primarily in the Philippines. Here in the Philippines, you could get dividend yields of 5 to 7%. So it
What?
so
I'm moving there.
hey guys, so we are back once again with Lisa Seery from Massachusetts, super smart financial coach to a lot of women out there. If you have not watched our first video, I'll put the link in the description where she shared her insights on what you're supposed to do with your money and her insights on investing in this new normal. Now, we're going to flip the switch. She's going to ask me questions. I don't know what she's going to ask me. I'm a bit scared because it's scary when a super smart and rich person would ask you questions, but I'm ready. So let's do this, Lisa.
All right, let's roll. So, Marvin, I want to know, how did you get started with investing?
I never had this idea that I would be an investor when I started out. I grew up from a normal family that I just really wanted to climb the corporate ladder and then somehow, some way, become management and get good benefits. That's all I wanted. Then somehow also save up enough money that I'll be okay later. I never had that ideology that I needed to start my own business or invest up until something happened to our family, that something happened with their finances, and then I realized that if I'll wait for old age before I start investing or start a business, if that happens to me too, then I might end up also with nothing. And what I've realized there is your job is there to give you security, but it's not there to give you freedom. It's not there to help you grow your money. And that's where I started a lot of entrepreneurial ventures in my early 20s. And as I started to, while I was doing that, I was barely spending money because I saw it. My mentality at that time was, my dad started businesses on his 50s. And because he made a mistake, he made mistakes off of it. I said to myself that if I'm going to make a mistake, which will happen, I don't want to do it in my 50s. I want to do it in my 20s when the stakes are lower. So I tried everything, lived super simple. Then as it started to earn, I tried to study, why not try investing it? And at that time, I was a big fan of Robert Kiyosaki. And I would read a lot of his books. And I'm not sure if you're familiar with Robert Kiyosaki, but he's really business. Don't invest. Don't give it. If it's investing, he's pretty much into real estate. He wasn't really keen on stocks at that time. But I invested in mutual funds. I invested in equity funds. Then what was so weird, and I guess a lot of people who've watched the channel know this, when I started to invest in equity funds, I was watching it every day. I was watching it every day. Then I said to myself, if I'm watching this every day, might as well try the market, because I don't know how it is there in the States, but here, mutual funds are normally the closing price of the market today, that will be the closing price of the mutual fund the next day. So I would look at it, when is the market down, because I would want to enter money the next day. So that's why I would watch it. That's why I would watch it daily. But that's what happened. And then when I started to try stocks, I really liked it. It was something that was fun. It was something that I could go on and talk to someone about it over and over and over, because it never felt like work to me. It was something that, especially when I was younger, I would read financial statements every day when I would get home from work, even though if I was tired. So then I just really liked it. Then the 2008 crash happened. It allowed me to position more. Then up until now, no regrets. It's one of the things that I have been doing, and I think even when I hit 80, 90 or 100, I'll still be doing this. So it's a combination of doing something that you love, and it's a combination of, I guess, building the craft and the skill into it. What I realized is this: you can still invest in the stock market, or at least have exposure to equities, even though you are not that skilled into it. Meaning, you can be a business person. Your business can earn well, but you can also take some of the income from that and then invest it in the market. So I think there's a sweet spot for everyone. It's just that there's a stigma in the market that you have to be either good in economics or accounting or numbers, or you need to be really rich to start, and that has prevented a lot of people from investing.
And you said a couple of really interesting things there. You said that your job is basically for security, what you do, and then investing is kind of like how you can just make an additional like income stream from that. So that's super important, because I think that a lot of people don't really think of that, and they don't really understand what dividend income is too. And like dividends are freaking amazing, right? If you have enough of them. So I love that story that you got started in your 20s based on, you know, what you saw happen in your family. So that's really, really, really awesome. Are you more of a fundamental investor, or are you more of a technical investor? Do you follow charts and patterns? What is your investing methodology?
That's a good question. I want to answer something first. You said something about dividends. You'll be shocked about this. In the States, right? The dividends that you will get is around 2%, or around, it's around that range. If you get something more than that, that's a bonus already. Here, before I invested in US stocks, I was just investing primarily in the Philippines. Here in the Philippines, you could get dividend yields of 5 to 7%. So it
What?
so
I'm moving there.
so and a lot of them are predictable. It's we were talking offline that the market here is smaller, but there's an advantage of having a smaller market, because it's the same conglomerates. The ones that have been rich for decades are the same, so you just have to bet on them. And here's what's interesting: the ones that have been giving large dividends are predictable telco stocks. They're not even super mature yet, because now there's been a shift to larger, faster speeds in broadband and 5G, 5G, etc. So there's still upside. To answer your question, I do both. What I've done is I've segmented my portfolio. I divided it. If this is my entire portfolio, I divided it into different portfolios still, smaller portfolios, portfolios for trading, portfolios for investing. Then the portfolios for investing, I still divided it further. When I say it's different portfolios, I use different brokerage accounts so I don't mix the money. So if I log into this brokerage account, it's specifically for this purpose. So I have a portfolio that's specifically for dividends. I have a portfolio that's specifically for buying stocks that are good, growing, and then when they're undervalued, I start coming into them. Then on the trading side also, I would segment that also, where there's a portfolio that specifically the rule is to follow the trend. Meaning if the trend is going down, I don't do anything, but once it starts to reverse and go up, that's where I start to come in as well. And then there's another portfolio where I trade this. I trade the volatility also. So I learned everything for the past years, but I started out as an investor. My idol was Warren Buffett, and that's why I would read a lot of financial statements. But what people don't understand about the markets is it's not just about the numbers, it's also about emotion. So when I saw my stocks go up, I sold too quick when I was starting out. So only to see them not go back to its previous price and to see them go higher. So the logic that I had there was, if they're not gonna go back to their previous price, maybe I should learn how to trade. And that's where trading also started to come in as well.
Okay, so I like how you said that you have brokerage accounts for different things, because I always think that I'm strange, like that so here in the US, like I have brokerage accounts for my retirement, but then I also have non-retirement, and I have two brokerage accounts. And people would say, well, why do you have two brokerage accounts? And I don't do trading anymore, but I do like to segment things as well. So that's interesting that you do that. And I think we started investing around the same time. So when you said that you sold too soon, was that after 2008 when you started investing a lot, buying those value stocks for basically nothing?
You know what's interesting? If that if that was the case, it would have been interesting. But I was so new at that time. Literally, I would buy something at 5, sell it at 6. Then it goes back to 5, 6, only to see it go to 70 at some point. Then I was looking back, I was scratching my head. I could have just held onto it also. But when you're starting those small gains, you look at it as wins already. Whoa, this is a good thing. I can do this every day, not knowing that it doesn't always happen like that. That when you start trading, the losses also would pile up. and that's why you have to be very disciplined when you start trading. So uh yeah, I think it was around that period. That's why I also wanted to separate my portfolio, because I call it my core. Anything that's in my core, the only reason for me to sell it is if any of my rules for investing would be out, meaning the company does not grow anymore, or if it's for dividends, the dividend yield is something that is not appealing to me, or I see it, the sales income suddenly start to slump, or they start losing money, then I'll sell. But if none of those conditions have been hit, I'm okay to hold them as part of my core for a very, very long time. So that's one of the actually it's one of the reasons why I split the portfolio, so that what's in it for trading will just be for trading, and then what's in it for investing, I don't plan to sell them unless there's any condition that will cause me to sell it as well.
Do you invest in foreign currencies, various currencies too, based on where you live? Like, do you like to have more exposure to, certain countries? How do you, I guess based on where you live, there are certain advantages with dividends and stuff in that market, right? But do you like to dabble and make sure that you're in other markets as well? I guess that's interesting to me as a US investor, which is a really big market.
The stock market still moves on supply and demand. However, I think it's easier for me to understand. Like, for example, if I'd study Starbucks, I could figure out that, hey, 2018 Starbucks had this much stores. 2020, this is how much stores Starbucks has. I see growth, but I can't do that for yen. I can't do that for the euro. It's pretty much basing it on macroeconomic indicators. And as what I've mentioned earlier, my background was pretty much entrepreneurial, so it was easier for me to understand businesses more than looking at the entire currency slash macroeconomy. But I've seen a lot of friends who want currencies more than stocks, because to them they just have to look at just a couple of currencies and just look at some macroeconomic indicators. But to me, it wasn't appealing for me, because in a way, this is how I'd see it. When you're trading the forex markets, it swings, and then you don't get any dividends. But in the stock market, there are some good stocks that even if there's swings, it's still trending up. And that's the difference. You don't see in currency markets, you don't see something like this. It's normally fluctuating in this. But what I've been doing is, I guess it's some sort of a hedge in terms of currency. I'm still collecting the dollar, and also, at least in our region, one of the more stable currencies in my region is the Singapore dollar as well. So at least a mix of that also. And I invest in Singapore stocks. So my exposure is Singapore stocks, US stocks, and then Philippine stocks. US markets give me, I guess, growth in terms of the biggest brands are still there. A lot of the cool stuff are in the US markets. Then a lot of the tech stocks are there. But Singapore gives me stability. The Singapore's a really, really stable country. Their currency is really stable, and the companies that they have there also, that at least that I like, are companies that I know are stable as well. And the REITs that they have there, I know there's a lot of REITs also in the States, but the REITs are amazing. Because the market in the Philippines is smaller, there are some products that were already available in Singapore way before it was available in the Philippines. So I was investing in gold ETFs. I was investing in China via ETFs way before it was available here. So that's how I somehow would diversify and would hedge my investments also. But yeah, different countries.
That's so interesting for me to hear, like being a US investor. Like, I love hearing stuff like that. And when you said Singapore REITs, I was like, okay, now I need to research Singapore REITs, because I like investing in REITs. Did you say gold ETFs?
Yeah.
Oh, you like gold. What other precious metals do you like?
Oh, just gold. Just in my opinion, it's not something that you get into as an entry level investment. I would go into gold if I have other investments already and I just want to use it as a form of hedging, because either way, there's like forex, there's no dividends towards it. But it's a good way that if markets go wrong, if the economy is wrong, you could see other commodities do better.
Gold, like, will always have like an intrinsic value, right? Rather than like currency like the US dollar. If there's more liquidity in the economy, or we're pumping more liquidity in, that devalues the US dollar. So That is super fascinating. So do you invest in cryptocurrency and Bitcoin?
At first, I was skeptical. I thought it was a big, I thought it was a big scam. I really didn't know what it is. But here's my philosophy. In the previous video, we talked about philosophies. One of the things that I would do is if I don't understand it, I don't know it, I don't get into it. So at the early stages of Bitcoin, I didn't understand it. I just thought, what, money, just from algorithms, from programming, from scratch. But as time went by, it got accepted, eh. And I think that's one of the facets of money, is when a larger group of people start to accept it and transact with it, then it will come a point in time that it will be used more. And given that what's happening right now, uh, the pandemic, fintech, everything will move towards, I guess, digital currencies, and Bitcoin is part of it. So I think I started investing sometime 2018. 2017, there was a large push up. It went to 20,000 US dollars. I think 3 or 4 months after that, when it started to drop. I wasn't one of the first ones that came in when it was massively high. I think it was around 5,000 at that time. So
I initially thought the same thing too. I was like, this is a scam. This isn't real. And then I feel like I got really busy during the time that it took off and with my job, and I never really looked into it. So that's not something that I own at all. So I'm very curious when people own it, when they get into it and all of that, because it's exciting, and who knows if it will be a future currency. I mean, more companies are adopting it, so it seems like it's trending that way. But what is the best investment advice you've ever received?
happy wife, happy life. This is something that I employ, and that's why I invest in Bitcoin. That's why I invest in all of these other assets, because I only invest an amount of money that even if it goes to zero, I'm okay with it. So everything that I put in, regardless if it's stocks, ETFs, REITs, uh, commodities, or even in cash accounts, it's only an amount of money that if it goes to zero, I'm okay. That's why I have a lot of friends that are real estate investors, and when you compare stocks and real estate, stocks look like a bit more riskier, or riskier asset class than real estate. But when I look at them, they leverage. They like leveraging. And for me, I'm not a big fan of debt. That's why I like stocks, because at least it's my money. If it goes to zero, I don't owe anything to anyone. So I guess that's it. And it's stuck to me this whole time. It has to be an amount of money that it's not just an amount of money that you can afford to lose, but it's an amount of money that if it goes down, it goes to zero. You won't lose sleep over. Your mother-in-law won't fight you, and you can still go on with your life. So that's what I've been doing ever since. The biggest mistake of people is they want to put in more than what they can tolerate, because they're just only thinking about the upside. But what if it does not go the way they want it to go? Me, I try to look at it from a different perspective. I look at the downside first, and whatever I get from the upside is a bonus for me, because that's where people panic. Eh. They can only, for example, they can only tolerate $1,000, but they put in $5,000 or $10,000, because they're thinking, if I hit a jackpot, this 10,000 will become 20,000. They don't want to earn 1,000 to 2,000. They want the 10,000 to 20,000, not knowing that what if it goes wrong and that 10,000 becomes 7,000? Can you tolerate it? One of my biggest secrets is, I know it's not the culture in the States, but here in Asia, we do this. If you can hold on and live with your parents for a long time, do it, because you'll save a lot of money. And that was one of my that was one of my secrets also. Save a lot from rent and house amortization.
But I think that's okay. You can really get ahead financially if you do that. I mean, yeah, I mean, it takes a little bit of tolerance to want to do that when you want your freedom. But yeah, I really like how you look at that, where you said that you look at the downside of it first, because you're right. So many people just look at the upside of the stock market without really assessing their risk tolerance if they lose that money. So that's why I think sometimes, and I talk about it with clients too, like, yes, you want to try and get a certain amount of returns, but also how are you going to feel if the market drops or this amount of money goes to this amount, like. So who is your favorite investor?
It was somehow progressive. When I was starting out, it was Warren Buffett. Then a few years later, I was following a lot of Peter Lynch. Then now it's Ray Dalio. But you can get bits and pieces of all of them. But if I have to pick between the three of them, I'll still pick Warren Buffett. His principles are, you know, what's so interesting about stocks is the principles are so easy to understand, but in actual life, when emotion kicks in, that's where it becomes harder, because what Warren Buffett is saying, anyone can do it, but it requires conviction and the discipline to do it. That you said it in the previous video: be greedy when others are fearful, and be fearful when others are greedy. But in actuality, when everyone is fearful, also you're thinking, what if this crashes even lower? What if there's no cure to the pandemic? What happens? So things like that. Yeah, I'll rank Warren Buffett will be in my Mount Rushmore of investing idols of sorts.
Yeah. Do you think that investors who are newer investors who had an experience like a crash of 2008 have some overconfidence over the course of the last 10 years with investing? Because I know people have told me, they're like, oh, Lisa, I'm so good at investing. Like, I've just invested money and it's taken off. But I'm like, have you invested during a down market? Like, because we were primarily in a straight up market through, you know, from 2009, 2010 through 2000, end of 2018 here in the US.
I think those that are passive, those that followed their plan and stuck to it, meaning they keep, you said in the previous video that they buy at consistent levels and they've been making money off of it. They're okay. It's the ones that came in at the right time and not knowing that it was the right time, because that's something that you can't replicate again. I believe in what you said, that those that came in when the market was about to go up and did not feel the pinch, they're the ones who were feeling it when the markets were also dropping. But I think that's the road also to maturity. I've not seen someone that has been good in the markets not experience any sort of loss, or it came to a point where they felt that, oh no, the market's crashing in on me and I'm not doing so well. So I think if they feel that they haven't had any type of loss, they haven't had so much experience yet, or they're super passive. That because at the end of the day, if you put your money in and then you leave it, and then you come back 10 years from now, especially if it's an index fund, they're still gonna perform. They're gonna do well. So I think it's also at the level of monitoring, because the same index fund, if you watch it on a day-to-day basis, there will be days that it will have its down streaks. There will be days that for a week it's all in the red. So I think it's also about what's your measuring stick.
And I'm actually glad that, you know, the markets had a lot of volatility this year, because if you had just been investing for 10 years and you're like, wow, this is wonderful, you know, where things are always going up, this year has probably taught you some lessons that, okay, like, how do my emotions really play into market volatility? Like, am I comfortable with losing money now? Or yeah, I think that just probably this year has taught a lot of millennials, at least, kind of a lot about their risk tolerance if they hadn't really thought about it much before. You said that you started with mutual funds. I know it's funny because when I started, you know, like, index funds were in their infancy, so it was more the mutual funds or stocks or what you invested in. So what advice, as far as what, you know, like, equity investments to invest in, would you say to a beginner investor?
This is what I always tell people: start now. Start with an amount that you can tolerate, and just keep on buying. Because when you start doing it and then you start at a small amount, for example, there's fractional shares now. You can even buy Amazon stock for 50 US dollars. So here's the thing: you buy Amazon stock, you put 50 US dollars, it drops by half, but your $50 just becomes $25. And the $25 that you lost, you would have spent more on that on a weekend buying other stuff that you don't need, and buying other stuff that won't actually matter over a period of time. So you start now, so you see, and then you try everything. You do index funds, you do ETFs, you do REITs, you do individual stocks, you do dividend stocks, you buy bonds, even though it's not really getting you anything. So you try it, and then you compare, and then do it for 1, 2, 3 years. Because if there's one thing that I know I have been exercising for the past decade or so of investing, I guess if there's a superpower, my superpower is patience. I'm okay that if it does not perform in X amount of time, I'm okay to wait it out. Patience for me is something that's so underrated in the world of investing because everyone wants to get rich quick. So my technique is I'm willing to wait because my mentality when I started out, I was in my early 20s. If this does not go up when I'm 25, 26, 28, 29, I'm still young and I still had a job at that time and I still had other investments at that time and I was also doing other side businesses at that time. So for me, whatever I would get from my investments was just a bonus. So my suggestion, try everything, try it small, then measure it up 2, 3 years later. The investment that does the best for you and the investment that you've gained the most skill at, that's where you put more money into. But don't waste your time. Uh, Invest as much as you can right now because if there's one thing that's variable between money and time, money that you lose you can always get back, but time that you lose you can never take it back. So if the more you delay it, it's not just the opportunity, but you fail to develop the skill and the experience. And I think that's the most important thing when it comes to investing.
Just starting for people is hard. Like it's especially if they haven't learned how to do it, their parents didn't do it. It just feels uncomfortable, right? And our brain wants to do like what's familiar naturally. So if someone wants to invest but they're like just afraid to start, I guess, like what's the simplest advice you could give them if we're just saying yes, just start, but how would you kind of like ease someone's mind, I guess, from if they were like, this is unfamiliar to me, I don't even know how to place a trade, how do I do this?
Of course, before you start and do anything, it's better to also study that you know what you're getting into. What I guess our biggest advantage now is the internet is there, that if there's a certain thing that you want to know, everything is available via Google or YouTube, that they can get the information as possible. But what I want to tell people is you don't have to be an expert just for you to start, but also there's a sweet spot in between that you don't come in that if you don't know what you're getting into because you'll be burned that way. You don't come in also just because your friend told you that, oh, it's good to invest right now. But you also don't allow not being an expert to prevent you from actually starting and being in the game. So once you feel comfortable already and at least you know what you're getting into, you know the risks, you know what could possibly happen, then you start putting into it. Because at the end of the day, people can watch our videos. When you start your YouTube channel, people will watch your videos because you're smarter than me or you're better at everything. But if they don't do anything, they don't take action, they don't execute all of this will just be entertainment. What's important is when people start watching this, they actually try and do it. So get enough information, but once they know what they're getting into, start and invest and put money, even no matter how small it is.
The baby steps to get going. Yeah, that's super, super important advice. What last minute advice would you give to your audience on investing?
I'll never stress this enough. Start now. Put as often as you can and be intentional with your money because people always say that it's hard to get rich, but what they don't realize, it's about being faithful with what you have right now. Because if you're not faithful with what you have right now, even if you get that million, even if you get that extra money, it will easily go away if you don't know how to handle it. So it's a test about what you have right now and how you handle it. Because if you know how to handle it when it's small, when more things come your way, you will know how to multiply it. Not just multiply it, you will know how to make it grow, you will know how to multiply it, and you will know how to preserve it. I've seen so many people lost more money when they were prosperous as compared to when they were in lack because they did not know how to handle the money. The culture here in the Philippines, it's so Americanized. America has influenced the Philippines more than any other culture, but we're the only ones in this region. Other countries have their different cultures, so it's pretty much the same. So if in the US people spend on stuff to look good, it's also the same here. People tend to upgrade their lifestyle by this to look good in front of their friends. So there. I've seen a lot of people when they start to earn more, they just keep buying stuff and they end up with nothing after.
You don't want to like just buy, right, and consume things and then lose all your wealth either. So I think that's really valuable advice that you shared with your audience. So thank you, Marvin. This was fun to get to interview you. So.
Yeah. It's one of the few times that a really rich person gets to interview me. So the honor is all mine. So anything that you would want to leave people also before we put this video to a close?
I would just say, similar to you, it's so important to just get started with investing and get over the fear that it's like you have to have a lot of money to start investing, or that you have to be an expert, or like all those things that you would tell yourself if you've never invested before, because it's not as complicated as like the Wall Street jargon makes it seem. So just take the actions and start doing it slowly until you're comfortable. This has been super fun, and you can find me. I mostly hang out on Instagram right now until I have a YouTube channel next year. So it's Lisa Seery, just my name _. So you can find me there and ask me any questions.
And if you guys want Lisa to have her YouTube channel expedited, put it in the comment section. I want Lisa, and let's see if she can have her. We can have her back also in the channel. So thank you so much. It's been a good back-to-back series with you. I hope that people got a lot from this conversation, and the whole intention of this is just to really share principles and strategies to all of you that it somehow helps. It somehow helps you and brings you closer to whatever dream, ambition, or goal that you have towards financial freedom. So that's it. Thank you, Lisa, for being part of this. And to everyone, trade well, trade strong, trade smart. See you all again soon, and God bless you. I look at the downside first, and whatever I get from the upside is. And I guess that's the context of my. That's a context.
Are you there?
Yep.
Okay.
Yep. And
sorry, you froze at some point.
Oh no, I was sharing my heart out. But anyway.